Hello students, this is going to be my mini lecture for chapter 9. This chapter is quite straightforward. There is not that many calculations, just a few. It's more of um, there is more focus here on management than accounting. The chapter is talking about performance management and responsibility accounting. It's really about large organizations that divide themselves in order to be efficient. They're subdivided into smaller units, divisions, departments, segments. And the question here, well, we divide our organization into smaller units so it's easier to manage. And the question is then, how do we evaluate performance measurement, how do we evaluate performance of managers of different departments, different divisions? Um, how do we hold them accountable? What measures do we use to efficiently evaluate units managers? That's pretty much the core, how to evaluate unit managers. There will be three types of units. We will differentiate among three of them: cost centers, profit centers, and investment centers. Excuse me. And then we will use, um, we will answer the question, well, how do I evaluate managers of cost centers? Well, we will evaluate them using so-called responsibility accounting report. And there's a concept of controllable costs. What about profit centers? How do we evaluate managers of profit centers? We will use departmental income statements and contributions to overhead reports. And the last one is, how are we going to evaluate managers of investment centers? And we will use these formulas: return on investment, residual income, profit margin, investment turnover, and balanced scorecard. So I will skip these two slides. You can look over them. Most of the companies are decentralized, and so, as I mentioned before, in order to be more efficient, corporations divide themselves up into smaller units. When we look at all of those units, on the bottom of the organizational chart, we usually have cost centers. So here's an example. It's a company that makes food and beverages. So on the bottom, you have plant managers, beverage department, food department, service department. So each one of these units is considered to be cost centers. These departments just make product. They do not generate revenues. So cost centers are responsible only for costs. Again, there are no revenues, right? So they're only costs. An example would be HR department, right? It just incurs costs: salaries, office costs, utilities, depreciation on office machinery. There are no revenues. Therefore there is no profit. Payroll department, it's a cost center. It just generates costs. Maintenance department. The second group, we have profit centers, where they're responsible for costs and revenues. So if you think about men's clothing department at Macy's, a clothing department has both costs, salaries, purchases, supplies, but also it generates revenues. So we can subtract costs from revenues, and we can prepare a departmental income statement to look at the profit. A single restaurant in a chain of restaurants. So a single restaurant does not have a right to make investment decisions. It doesn't have a right to purchase new buildings, but it does generate both revenues and costs. A service department in an auto dealership. So profit centers are right here in the middle. And then at the top, we have investment centers. I like to think of them as strategic business units. They're really mini organizations. They're quite independent. So they are responsible not only for revenues and costs, they also can buy large assets. They can buy land, they can buy factories, they can buy buildings, they have a right to make investments. And so I can evaluate managers of those investment centers based on the efficiency of generating investments. And examples would be, we have General Motors, so the whole division for Chevy, it's like a semi-independent company. That's an investment center. For Disney, a division of theme parks or a division of movies would be an investment center. So again, they're at the top. So here are again cost centers. We will talk about them. How do I evaluate these managers? We will use so-called responsibility accounting reports. Sometimes it's called a performance report. So I'm going to use that report to evaluate managers of cost centers. Profit centers. How do I evaluate managers of profit centers? We will use department income statements, and we will also use contribution to overhead. And finally, how do I evaluate the managers for investment centers? We will use these formulas: return on investment, or ROI, profit margin, investment turnover, residual income. Okay, so let's talk about cost centers first, right? Cost centers. Prepare a performance report using controllable costs. So the main idea here, and it should make sense, I should be evaluating my managers of cost centers only based on costs that they can control. So a manager does not control his or her own salary. I should not be using manager's salary. It's considered to be an uncontrollable cost. So I should not, it's not within the manager's influence. So I should not be using those costs, or like depreciation on plant equipment. Well, the manager did not acquire this equipment, did not calculate depreciation. I should exclude uncontrollable costs. Only controllable costs should be used to evaluate manager performance, such as supplies used in the manager's department. I want to mention that at the top, all costs are controllable. Right here, all costs are controllable. On the bottom, many costs are non-controllable, uncontrollable, and we should not use them to evaluate managers' performance. Responsibility accounting recognizes that control over costs and expenses belongs to many levels of management, and all costs are controllable only at the top. I'm going back. So responsibility accounting system, I mentioned it. Okay, let's go forward. So let's prepare responsibility accounting report. It will list budgeted and actual expenses. So budget and what's the actual, what's the difference? Is the difference favorable or unfavorable? Only for those costs that the manager is responsible for. The amount of detail decreases as we go up levels of management. The amount of detail decreases, but the scope increases. So like a department manager receives a very detailed reports, but when we go above her to the store manager, she receives summarized reports. So the amount of detail decreases. There is a lot of detail at the lower level, less detail at the higher level, but the scope goes up. So this is an example. So if you look on the bottom, this is the cost center, right? Cost center. So for the plant manager, beverage department, so there's all these controllable costs: direct materials, direct labor, overhead. Then we just take the totals and we move them right here. So for the vice president, there is less detail, and we include only controllable costs. So if you think about salaries for management, depreciation, or insurance, these costs are uncontrollable at the cost center level, but they will be controllable at the vice president level. So look at the direct materials, budget, actual amount. So we're over budget, right? We are $900. So this would be, sometimes we put a letter, you can see a letter sometimes U here, unfavorable. But direct labor and overhead, we are below budget, so this would be favorable. So this is an example of the performance report. Then it goes to the vice president, right? So we get just one line, less detail for each department, and we include more controllable costs. And again, you can see unfavorable, favorable. And then at the top, everything is controllable. So quality control costs are uncontrollable at the vice president level. Or salaries for VPs, but at the executive VP level, they are controllable. So that's an example of the responsibility accounting performance report. That's it. Now, the next level, we're going to the second level. We're going to talk about profit centers, right? So we're going to talk about here, men's clothing department, or a single restaurant in a chain of restaurants, or a service department in the car dealership. So here we have profit centers, and these profit centers, they generate both revenues and costs, so we can prepare departmental income statements. Now, one of the major challenges here, couple of them, right? First of all, well, what about joint costs, indirect expenses? What about utilities? We have men's clothing department, women's clothing department, we have children's clothing department. Well, utilities or rent, if they're all located in the same store, are shared or joint costs. They benefit multiple departments. How do we allocate them? So-called indirect expenses. And the second one, what about support departments? What about their salaries, their supplies, their costs, their expenses? What about purchasing? It's one department that serves everybody. What about HR or payroll or accounting? How do we allocate those traceable expenses? And so when we talk about direct expenses, these are easy, right? Direct expenses are costs traced directly to a specific department. They take place to benefit just that one department. Indirect, that's where we have accounting problems. Joint costs, they cannot be traced to one department. So if we can allocate them, we will allocate them, and we will use cost drivers. Very similar to chapter 4, activity-based costing. And some common costs such as property taxes or factory insurance or office salaries, we cannot allocate to a specific department. So we probably should just ignore them. It's unfair to allocate. If we cannot allocate, we should not be including them in that department's income statement. So these are examples of how we're gonna allocate service department expenses based on the cost driver, right? So office expenses based on number of employees, same with personnel, payroll, this will be given to you, right? Purchasing cost based on the number of POs processed. Maintenance expense may be based on the square footage, how much floor is occupied by each department. So here's an example. You will have these types of problems of different type. So we have classic jewelry pays janitorial service $800 per month to clean its store. Management allocates this $800 to 3 departments based on the amount of floor space each department occupies. So right in here you can see 3 departments: jewelry, watch repair, and China and silver department. There are a couple of ways of thinking about it. So this is the way your textbook does it. This is square footage for each department. The total is 4,000 square foot. And then what they do, they square feet, I'm sorry, and then they calculate percentage, right? They take departmental square footage, 2,400, divided into 4,000. It's like departmental activity divided into total activity gives us a percentage, 60%, and then multiplied by the total cost. So if janitorial service is $800, 60% of that is allocated to jewelry, 15% to watch repair, and 25% to China and silver. Very straightforward, right? So again, I take that department's activity, divide by total activity, and multiply by the total cost. Another way, which I prefer, alternative method, I can simply take $800 total cost, divide by total activity, total square feet. So if I take 800 bucks, divide by 4,000 square feet, I get 20 cents per square foot. So if jewelry has 2,400 square feet, multiplied by 20 cents, I get the same $480 allocated. Now, right here, in class, I usually go over this exercise 9-5 and a little bit more complicated scenario for quick study 9-8. What I will do, I will actually place on Canvas together with the video solutions. So I have right here solutions to every problem, like this is the quick study 9-8 solution. This is exercise 9-5. So whatever I refer to right here in yellow boxes in my PowerPoint, I have solutions for those problems which will be available for you. Again, the instructions you can read in the book online or the actual book, and the solution is in this file, which I will place a link to on Canvas. Okay, so this is cost allocation. Moving on, departmental income statements. Guys, these are the steps. You don't have to prepare departmental income statements on the test. You can go over this example. You know, it's a lot of numbers. It doesn't really matter. The examples, the problems you will have to solve in your homework will be much more simple. This is an example, right? So you will be given information like this, and you will, like, you know, information about sales and expenses, and then you have to prepare an income statement. So this is the combined income statement, and we have three departments: hardware, houseware, and appliances. So you have all your different, you know, salaries, expense, depreciation, expense. So we have direct expenses right here, directly they're direct to that department, right? And then you have allocated indirect. We learned how to allocate based on some cost driver. And then you have allocated service departments, right? So like office expenses or purchasing department, you know, benefits everybody. So that's how we allocate them. And based on this departmental income statement, you can see right here that appliances department has a net loss, right? So it looks like we need to get rid of it. We should eliminate it. But, you know, if I eliminate this department, appliances department, this might be misleading. My indirect expenses, my advertising, my insurance, and my service department expenses, most of this will not go away, right? I still have to pay rent. I still have to advertise. I might decrease advertising or utilities a little bit, but most of these indirect expenses will remain. So this is not a very good method. A different and probably better method to use to evaluate managers of profit centers is to calculate departmental contribution to overhead. So we take revenue and we only subtract direct expenses. That's it, only direct expenses. Most of the indirect expenses are overhead. That's why we call it departmental contribution to overhead. Again, we would just take revenue and only subtract COGS and these three, right? Direct expenses, only direct expenses. So departmental contribution to overhead, the higher it is, the better the profit center is performing. It's used to evaluate departmental performance is not a function of arbitrary allocation of indirect expenses. And so a department or a profit center might be a candidate for elimination when the departmental contribution is negative. Not operating income, not net income, but rather departmental contribution to overhead. Here is an example. So we ignore indirect expenses, right? We have the same three departments. We take sales or revenues, and we only subtract COGS, which is a direct expense, salaries, depreciation for equipment, and supplies. And now if I'm looking at appliances, right? Appliances department, their departmental contribution to overhead is positive. So based on the departmental contribution to overhead, I should not be eliminating the appliances department. Here's exercise 9.8. Again, I recommend you take a look at it because those are the types of problems you will have in your homework quiz and on the test. And the solutions will be available for you on Canvas. Okay, the last one. So we're done with cost centers, we're done with profit centers. Let's move to investment centers. So analyze investment centers. We're using formulas. Some of these, like return on investment and profit margin, they should be familiar to you from Business 1A. I'm not going to go over calculations here. So you've got the formulas: return on investment, Return on investment is just net income divided by average assets. So I think of it as how much profit does every dollar of assets generate, right? So here are examples. You can do the calculation. The higher ROI, right? The higher ROI means the investment center or its manager are doing better. Now, there are two other formulas. There's profit margin. You take net income divided by sales or revenues. So this one, again, we used in Business 1A. This one tells me how much profit does every dollar of sale generate, right? So if the profit margin is 3%, it means the company keeps 3 cents in profit for every dollar of sales. Higher, better. Investment turnover is your sales divided by average assets, right? How much sales do you generate? Investment turnover. How much, why do we buy assets? Why do we buy equipment? Why do we buy land and buildings and brand names and copyrights and patents? To generate revenues, right? So how much sales does every dollar of assets generate? And these are the examples. There is a great exercise. Again, I will have solutions. So you will be asked to use these formulas, in your homework on the test. I think I'm asking you to calculate it in the in-class activity for graded discussion board. And then, guys, there is residual income. Usually, a company sets so-called target or minimum income. We all corporations, all businesses borrow money. We have loans, right? We get loans from banks, so we have to, pay other lenders. So what's the average cost of my capital? What's the average cost of interest? What is the interest on average that I have to pay for my loans? Let's say it's 8%, right? So if the target net income is 8% of assets, so I have to, my actual profit should be higher than that. So you take your average assets and you multiply by that target percentage, that so-called RRR, required rate of return. It will be given to you. And so whatever your net income is, investment center net income, minus that so-called minimum income, right? I have to make, my assets must have to generate at least $200,000. I bought this building and I got a loan at 8%, and I bought the building for $2.5 million. Well, I have to pay back 8% of that, which is $200,000. So whatever my net income is minus this minimum gives me a cushion, or so-called residual income. The higher this residual income, the better I am performing. Now, this is a couple of last concepts. This is a great concept. Balanced scorecard is a very interesting concept. It's been around for a while. Many organizations, companies, and nonprofits go in that way. If you think about all previous performance measures for the investment centers, they only included monetary measures, and it's not fair. So a balanced scorecard includes financial measures, as we just talked about. But in addition, hence the name balanced, we also look at other factors. We're looking at the group of criteria for learning and innovation. How much does the company spend on employee trainings? How much does it spend on new product development? How much does it spend on research and development? So we evaluate managers of the investment centers based on these 4 different groups of factors: learning and innovation, financial measures, internal processes. What's the number of rejects or defects? How much waste? What's the delivery time to customer? And also more qualitative, right? Customer satisfaction. What's customer loyalty? How many customers are repeating business? What's the number of complaints? What's the brand reputation? So it's a more balanced, better view, not view, a better way to evaluate managers of investment centers. And guys, the last concept here is talking about transfer pricing. Transfer pricing is, we have 2 departments. I have a car manufacturing department, and also I have a department, or a division, I should say, not department, that makes batteries. both belong to me. And so if my car manufacturing division purchases battery from my battery division, how much should the battery division charge them? So what's the transfer price? So the transfer price has no direct impact on the company's profit, but it could impact investment center's performance evaluation. And guys, it could get more complicated. We talk about transfer pricing in much more detail at a higher level course called cost accounting. But here, guys, the transfer price will fall somewhere between the cost to make the part, right? So like $40, and the market price, price at which our batteries are sold to the outsiders. So it's somewhere between the cost and the market price. And it depends on the capacity. It depends on how many orders we have. So this concludes chapter 9. Thank you for your attention, and I wish you happy studies.